All right, thank you, Sam. I wanted to start today just by showing you a list of all the major market drivers that we look at when analyzing a market. I'm going to touch on many of these today, but there's really two key drivers I want to highlight for today's discussion. And the reason is feedstocks and the supply and demand of polypropylene itself. These two drivers have the potential to impact the market in ways we haven't seen for a while. So we're going to start with feedstocks, and before we get into the future, helps to look at where we've been. This chart here is the US PGP price going back to 2009, and really two things I want to point out here. First, for a little perspective, we drop in prices from other key regions. We've got Europe and Far East Asia, PGP. Number one is just the overall high level of price of propylene here in North America. On average, propylene prices here have been about 1 cent a pound higher than Europe and 7 to 8 cents higher than propylene prices in the Far East. And then number two is the volatility. Definitely a much more volatile marketplace we have here in this region than we see in the rest of the world. And it's really these two things that have made propylene and polypropylene such a difficult business to be a part of these last several years. So why the high price? Why all this volatility? Well, if we think about where propylene comes from, its two largest sources of supply are from the refinery and from the steam cracker. In both cases, propylene is a byproduct. It's made as a consequence of other objectives. Now, historically, the supply has been split roughly 50-50 between the two. But today it looks more like 65-35. And it's not because we're gaining supply from the refinery, it's because we're losing supply from the steam cracker. Now, to quickly explain why this is happening, this is a typical yield profile of a steam cracker. You have your feed options across the top and your byproducts down the side. So we're all now aware of the shale gas revolution taking place in this region and the impact it's had on natural gas liquids, etc. And in a nutshell, this shale gas phenomena has created a shift in the cost economics such that the yields of propylene as a byproduct of the steam cracker are down significantly. The yields of propylene from cracking ethane are about a fifth of what they are from the other feed options. The industry refers to this as the ethane advantage, as ethane has become the cost advantage feed. More and more ethane is getting consumed, and that's really been a problem for propylene. To me, it's really probably the single biggest factor that's affected propylene prices and the volatility over the last several years. The numbers show that we've lost about 5.9 billion pounds of propylene supply since its peak. Okay, and the bulk of this is because of shale. It's because of the ethane advantage. Just to show you that our price, PGP prices, are not a direct result of oil. Oil's not the main driver of propylene prices, as many suspect. So this chart here shows PGP prices here against crude oil. This has been equalized to dollars per gallon. And if you go back to around 2011 here, you can see oil's been fairly stable, relatively stable. Propylene, on the other hand, all over the place. I mean, there's times where propylene is priced at parity with oil, other times a huge premium. There's times when oil's going down, propylene's moving up, and vice versa. We're actually in a period like that right now. If you see to the right, propylene prices are up 9 cents a pound over the last several months. All the while, oil prices have been coming down. So oil is not the main driver of propylene prices. It's the supply and demand of propylene itself. So what the industry needs are new sources of propylene supply. And the most viable solutions are not from traditional sources like the refinery or the steam cracker, but from the various on-purpose technologies that are out there today. The technology that's getting the most attention is propane dehydrogenation, or PDH for short. A couple of the reasons why PDH is getting all the attention. Here we look at its feedstock, which is propane. Big increases in the production of propane. Since 2010, production has been increasing at a rate of about 12.5%, and this is projected to continue, well into the future. Now, this too here is also a result of shale, and all the NGLs that are now coming out of the ground, propane being one of them. So up to this point, really, this shale gas phenomena has been more of a problem for propylene, but hopefully soon that trend is about to change. Here we show the cash margins of making propylene from PDH technology. Going back to 2011, margins have been averaging about 32 cents a pound, very attractive margins. So these are a couple of the reasons why PDH technology is getting the attention and why we're starting to see investment. So this here is just a list of all the announced propylene capacity additions in North America. In total, there's been 10 announcements for on-purpose propylene, 9 of which are from PDH technology. Since the original announcements, there have been plenty of changes, so we'll kind of recap where things are right now. At the top, we have FHR. This is the old petrologistics unit. It's already operational. It's been running since 2010. Next, we have Dow and Enterprise. We know these two units are going to happen. Okay, Dow has broken ground. They've announced they expect construction to be complete by April of next year, and that they could be fully operational by mid-2015. Following that will be Enterprise. They're expected to be fully operational by the first half 2016. And then if we go to the bottom of the list here, we have Dow, Petrologistics, and Enterprise. These were to be the second units for these companies, all of which are tabled for the immediate future. And then in the middle, we have Ascend, Formosa, Rexpro, and Williams. Formosa has received permitting for their PDH unit, but the timing and completion of this unit still somewhat in question. I know they have started front-end engineering, but likely we'll see when they want to break ground. Ascend, they were originally scheduled to be operational in the second half of 2016. We know this is not going to happen. Ascend is reevaluating their investment. And really it's the same with Rexpro and Williams as well. Basically everyone in the middle here is taking a step back and taking a more cautious approach to these investments. Some of the reasons why. Number one, a fear of overbuilding, okay? And then will there be demand? Lots of questions. How quickly, how much, from where? Will there be feedstock supply? Initially this was a concern. I think the reality has shown us now we're getting plenty of propane out of the ground. This really is no longer a big concern. Will there be resources to build? This is really where we're seeing the main issues. As a couple people have mentioned today, billions of dollars of investment taking place in energy and the petrochemical space. We're already seeing shortages of people, other resources, and this is leading to higher costs. So a PDH unit, very capital intensive to build. Grassroots unit, roughly $1 billion. What we're seeing now though, costs are increasing, as much as 50% and even more in some cases. So ultimately what we've got Dow and Enterprise. These two PDH units are coming as early as the middle of next year. This is going to give us 3.3 billion pounds of new propylene supply, an increase of 11.5%. So we do think there is going to be a third unit, a fourth unit, and probably even a fifth unit, but still a lot of questions on the who and the when. All right, so what does this mean for propylene prices? Well, in the short term, let's say the next 6 to 9 months, I think we can expect propylene prices to follow recent trends where it will continue to carry a premium to the global price. Supply and demand will continue to be tight with very little cushion to handle supply disruptions. And of course, unplanned outages will also influence pricing and volatility. Once we get the arrival of this new PDH supply, we do think that there will be a price response in the other direction. Now, estimating exactly what that's going to be very difficult, a lot of factors involved, but a good place to start is to think about where are these new propylene pounds going to go? And initially, propylene's going to have to look for arbitrages, export opportunities to move derivatives into other regions. So one of the easiest and quickest ways to absorb these pounds is to export polypropylene. So if we think about over the past couple years, where would propylene prices have needed to be in order to export polypropylene into, let's say, Latin America or the Far East, and prices would have had to be lower by 8 to 15 cents a pound. So this gives us maybe a reasonable estimate of what this price response could look like. All right, so let's summarize the feedstock section. The main takeaways here: investment in PDH is here. 3.3 billion pounds of supply. This is Dow and Enterprise. This is the first wave that'll be coming. Economics look good. Margins are strong, very attractive margins. Plenty of propane to supply these units. We just talked about the price response, and at the very least, it should help bring our propylene prices down to a more globally competitive level, and this should go a long ways to helping reduce some of the volatility that's been in the marketplace. So there is a light at the end of the tunnel here on the monomer side. The U.S. has this advantaged resource, and there is reason to be optimistic about the future. Okay, so let's move into the next driver I wanted to highlight today, which is the supply and demand of polypropylene. And so we'll start by looking at North American total demand for polypropylene. This goes back to 2007. 2007 was the peak year for polypropylene demand. Then we had the crash in 2008 due to financial crisis. And really from there, just kind of a combination of variables that have caused demand to be stagnant to declining. Since our peak year in 2007, the industry is down about 15.5%, which is the equivalent of about 3 billion pounds a year. So some of the reasons for the negative demand growth, number one, of course, just demand destruction, due to the higher prices of propylene that we see here. We have seen some material substitution, whether it be polyethylene or other plastics or even other material families altogether. Offshoring, simple applications moving to low-cost regions, but by far our biggest loss of demand is our loss of exports. So here we look at North American export demand, and really, exports have come down to bare minimum levels. From its peak years, export demand is down 73%. And if we think about all the demand we've lost, which I mentioned 3 billion pounds a year, almost half of that is due to the loss of exports. Here we can see exports now only represent about 3.4% of the total industry. All right, so now we'll look at domestic demand. Okay, little bit better picture here. Can actually see since 2010, demand has started to rebound. We've actually been growing at a rate 1.8%, which is just underneath GDP growth at 2.7%. So a little bit brighter outlook here, but at the end of the day, the industry is still out 3 billion pounds a year. And so, what happened as we were losing this demand, the industry found itself with excess capacity. And so this is just a list of all the units, polypropylene units, that have been taken out of the system over the past several years. It was definitely a period of capacity reductions. In total, 4.2 billion pounds have been taken out, the last of which was Phillips Samica, which closed up at the end of 2011. All right, so even though we've been losing demand in polypropylene, our operating rates have been increasing pretty steadily. And so where we sit today, 2014, industry rates are at 88.6%. Okay, that's the highest level we've seen in recent history, and it's probably going to continue to increase. Now, 88.6% really, it may not seem critical today, but when we consider some other factors, such as our monthly demand trends, which we see here, we can see some pretty big shifts in demand from month to month. Actually looks a lot like our pricing, lots of volatility. Now, if we also consider that producers have been doing a pretty good job of matching supply with demand, that 88.6% quite often feels like 99% at certain times of the year. The main point really I'm trying to make here is that rates are in fact increasing, the market is getting tighter, and we're starting to see evidence of this. One of the areas where we're seeing this evidence is in the spot market for polypropylene. This chart here, linear trend line of the margins in polypropylene in the spot market. Over the last several years, spot prices relative to monomer are up about 4 to 5 cents a pound. Okay, it doesn't mean that prices are up across the board 4 to 5 cents. It basically tells me that on average, the spot market is pricing at parity or at a premium much more often than it used to. All right, so let's summarize the situation. We have asset closures have balanced supply and demand. Operating rates are trending higher. Producers are gaining pricing power. We're seeing margin expansion in the secondary markets. We're also seeing margin expansion in the contract markets. But one of the problems that producers have is pricing structures today are still dominated by cost plus type pricing. And the contract market is the bulk of the industry, as we see it today. So cost plus type pricing structures essentially fixes your margins. So although producers are gaining pricing power, they basically limited their ability to exercise it. Okay, so what we're seeing in the contract markets, margins are up about 2 cents a pound over the last couple years, about a penny a year. Currently, there are efforts to increase margins even further. Anyone who buys polypropylene here, you've seen the letters. Producers are having some success with this, but again, it's been difficult to implement across the board because of the pricing structures that are in place today. Ultimately, we do think that they are going to be able to push these margin expansions through, not all of them, the first 2 cents. This will likely happen as contracts renew at the end of the year here, and it'll be implemented into the market by either December or January. We also think that there's going to be a big push to change the pricing structures in the industry in a way that allows margins to expand or contract, based on what market conditions allow. All right, so we have this new monomer supply coming. We think this is going to help bring prices down to a more globally competitive level, and this should allow for some growth, okay? So let's consider just a simple scenario. Let's say that domestic demand can increase, can grow just under GDP, 2.5%. And then let's project that exports can about double, okay, from where they're at today, which is still only half the volume of what exports used to be. Under this scenario, total demand increases by 1 billion pounds a year. Now keep in mind, this billion pounds of growth still only consumes 30% of the new monomer supply that's coming from Dow and Enterprise. But under this scenario, operating rates quickly jump to 92.5%. Okay, and to me, this is a pretty conservative scenario, a more aggressive one, and of course, rates jump quite a bit more than that, and it could start to happen fairly quickly. So we have a situation where, we're seeing the investment on the monomer side. We've got 3.3 billion pounds coming, but on the polypropylene side, we really haven't seen anyone come forward with new investments there. There is one, Rextac is out there. They've announced their intention to build polypropylene down in Odessa, Texas. Okay, but we know that's not happening, at least, in the time frame that they originally intended. And beyond that, there really hasn't been anyone else. So this is definitely one of the big questions in the industry. It's one of the big questions for the PDH guys, who's going to build polypropylene. But if you think about, from an investment perspective, it's difficult to go to your board, ask for hundreds of millions of dollars to build polypropylene when demand has been declining. Your margins aren't very good. They're improving, but they're still not reinvestment levels. And your pricing structures have limited your ability to expand margins. So not exactly a recipe for investment. I do think that things are starting to change. This monomer's coming. Prices should come down. This will allow for some growth. And if producers can show some improvement, their ability to show pricing power, eventually we will see some investment on the polypropylene side. But in the meantime, over the next couple years, anyone who's buying polypropylene, you need to expect that market conditions are going to continue to get tighter. All right, we'll take some questions here. I do have a few more slides. There's been a lot of questions about the current market, where prices are going with oil and all that. So I've got a couple more, but anyone have any questions at this point?
Yeah, where's polypropylene? What market or what segment is the big user?
You have the big users, fiber markets. Film is a big segment. Injection molding, consumer products.
So has it lost position in those markets? Or?
Yeah, a little bit. A little bit, yeah.
They're making a push to get polypropylene in the market.
Yeah, no, there's some.
Automotive's another big one.
What's your short-term view in terms of a buying signal? If you're, you need to buy, do you buy now?
Not right now.
No?
No, I sit out October, which is pretty much over. Hopefully,
Yeah.
anyone who's been talking with me is only buying what they have needed to buy. And we do think there is a correction coming in price. starting in November, probably continuing into December. We'll look at that here in a second. Well, we'll jump into it right now. So start here. This is propylene inventories, and this kind of tells a story of where we've been here the last couple months. Focus on the black line. This is 2014, and you can see inventories of propylene monomer steadily decreasing. I mean, it's been drawn down 11, 12 weeks in a row here. And where they sit today, lowest level since 2011. So this is really due to a bunch of outages, some planned, some unplanned, that have been out there. And ultimately, this has led to the price increases that we've had here in October. Now, we do know that supply is coming back. A lot of these refineries, FCC units, the PDH unit that was down, they're restarting. Supply is coming back. These inventories lag by a week or two. So what we're really looking for is this thing to bottom out there and start coming back up. But the market is already behaving. It's seeing this new supply come in. Spot prices are down. So, a lot of the questions I've been getting is, okay, well, what's going to happen? How much is it coming off? And so just a couple benchmarks for everyone to consider here. Now, I know earlier I said, oil's not the main driver of propylene prices, and it's true, it's not. But it'd be foolish to think that it doesn't have, any impact at all. The way I like to look at the PGP oil relationship is oil creates this window of where PGP will trade. Granted, it's a wide window because of our supply issues, and that's where we see this volatility. So this chart here is a representation of that. You have your lower end and your upper end, and that's all driven by the oil price historically here. And in the middle is our actual PGP contract price. And you can see we kind of float up and down, within this window. So based on, what's been happening recently and the inventories coming down, would imagine we'd be at the upper end of this window. And now with oil prices coming down $20 a barrel, we've actually busted right through the top end of it. And so propylene right now is looking very overpriced, okay? So let's say that we don't see any more problems, supply's coming back, and things get into balance. When things are in balance, what's that relationship look like? And if we come down, right around to the middle, slightly below actually is where the average point is. And you're looking at 58 to 60 cent PGP, based on this benchmark. So a decrease of 17, 18 cents, maybe on the horizon. Another good benchmark to look at here is prices around the rest of the world. I'm using the Far East here because this has actually come into play. So what we have here, our current PGP price, 76.5 cents, and there's the PGP price in the Far East, 53 cents a pound, and falling. Okay, it's still on the move. It's chasing oil itself. So this is a gap, 23.5 cents. Definitely a very large gap between regions. The arbitrage is wide open, even when you consider very expensive freight to ship propylene monomer. But we've got 70 million pounds on its way here right now as we speak because of that gap. And of course, once it gets here in mid-November, that also helps our supply situation. Helps get us back into balance. So based on recent history of the relationship between our price and the prices in the Far East, we do carry a premium to them, but where that average premium would put us right around 60 cents a pound. So again, about a 17-cent decrease. So assuming that things go as planned here and supply does get back into balance, everyone here can expect a pretty nice correction in price over the next couple months, I would say.
Basically.
Yes?
Yeah, I'm struggling with, you refer to it as an ethane advantage.
Yeah.
And I, you know, maybe I think too simply, but I think, okay, fracking is increased supply, decreased prices overall. Whether ethane gets an advantage or not, I'm struggling to understand why propylene doesn't have the same, at least some of the byproduct.
Well, let me see, what's the best way to go about this? So yeah, that's a good way to start, is propylene is a byproduct
Yeah.
of the steam cracker.
Yep.
And ethane, which we're getting an abundance of, from the shale. The one way to think about ethane too is it has very few demand streams. It either stays in natural gas and is used as a fuel, or it goes to make ethylene. Okay, and that's about it. It's difficult to ship as well. Its boiling point is negative 128 or something, so it has to be chilled and compressed. Very difficult to ship, so it basically moves by pipeline. And because of that, its price moves, instead of moving with oil like propane or butane or any other petrochemicals like that, ethane moves with natural gas. It's more closely related. And with natural gas is cheap, ethane, and you saw some charts earlier, has basically come down to its burn value. Okay, it's super cheap. And because of that, all the steam crackers are preferring to crack ethane in the steam crackers. So the percentage, someone had shown the percentage earlier, the percentage of ethane going into the steam cracker to make ethylene is way up. And then the problem for propylene is that the yields come way down. They're about a fifth. Is that?
The yield. It's the yield, right?
It's the yield, yeah. Yeah.
Yeah,
Does that make sense?
Yeah, it does.